Interesting regarding a indicator that I look at in assessing the unfolding real estate bear market. And one of the tools you can use is technical analysis, and it's just a measurement of supply and demand. Sort of dislike the name technical analysis, but it's more of a way to measure the strength of a bull or bear market, supply and demand, and so forth. So this is an important chart that I'm watching. Now, what it is, for those who've never used technical analysis, you take the S&P, in this case, TSX Real Estate Index, and then just ratio that with the TSX index itself so we can see where the underlying strength is. And what's great about this chart, we can see the bear market that occurred in the 1990s, where real estate was massively underperforming the rest of the market. And that, as we know, ended in about 2000, 2001. You notice the chart there at the bottom. So that we see a secular rise that started to weaken in around 2020. We got the final blow off with the collapse of interest rates at a 5,000-year low. And notice the trend line again is weakening, and it's about to break through that trend line or secular rise since 2000. Hence, I put the real estate bull market 2000, 2022, 2024. And that lines up perfectly, right, with a generational cycle, right? The Kuznets cycle, various interpretations of it, but it's about 18 to 25 years. And this will be the end of the millennial boom. So if you look at this chart again, you can see that the real estate bear market should commence significantly. 2024 has always been the critical year when the convergence of three cycles peak and actually turn down. And you can see that that trend line and this ratio is falling in line, that it should break through, and it should be very clear by 2024 that the bear market in real estate. And how will we know? You'll start to see speculators, right, start to unload their assets, that all of a sudden there will be a panic. My bet is that most of them have never experienced a bear market, so they have no idea that the psychology changes dramatically. One that has gone through that, I recall the bull market in real estate, and my ignorance, as I've alluded many times, I bought at the top. There was a panic, you can never afford. And that's the same thing that has occurred over the past 5 years up until recently. And that will break. And once it breaks, the whole psychology of the 1990s was real estate was a place to live again. And speculation, which pretty much was destroyed, a lot of industries went under. So that's the key. And once that breaks, it's the end of this bull market. And you'll see the psychology change with the public, speculators, mortgage business, the banking business, politicians, social mood, right? This is the whole study. Um, I've always said if you like more information specifically regarding the markets, I've just switched the Substack account solely for the model, right? This is a Telltale model, the economic long way tactical asset allocation model in its long form, right? And what that model does is it guides you, right? It's a satellite view of what's coming, but it's specific toward the assets, real estate, stocks, bonds, gold, silver, Bitcoin, what's strong, what's weak, and it's to avoid major collapses. And as I alluded to, the 23 years and it was in the investment business, avoided the collapse in 2000 and 2008. And I've been warning, obviously, a lot of people know me, warning about this real estate bubble since I started on Twitter 3 years ago. And it's unfolding as it would simply when the demand won't be there, supply will be increasing. That nobody's paying attention to that one. And then, of course, the end of the 5,000-year low in interest rates, or as we know it in the long wave, the monetary wave, right? This is where you get the deregulation of the fire industry and their product, which is credit, falls. So that facilitates Ponzi finance, right? The last great monetary wave was the 1920s. And what happened? Everybody knows about the 1930s. Same thing happened. The falling price of credit allowed people to facilitate more and more credit. And that credit wasn't sustainable. and it deleveraged. And that's what we're facing in the future. So hope you found this informative. Try to keep it short and to the point. And I'm enjoying this too because it's a better way to articulate each chart that telegraphs a story about what is about to unfold. As always, we will talk soon.